Okay, good evening everybody. What we're going to do today is take you through our interim results. There is a nice picture there of us without our chairman, Peter. He has been with us on the road shows over the last 2 days. So what we're going to do is give you a brief summary to begin with, which just picks out key highlights, and then we'll run into some detail which I'll support and James will clearly chip in, particularly around the financials. As far as the highlights are concerned, as you're well aware, we had a successful IPO on the 10th of June. Thank you for your support in helping us do that, raising 63.5 million. And we've reduced our net debt over that period using a significant amount of those funds, and James will clearly pick up the detail of that. In terms of trading, I think we've consistently said that we're in line with expectation, and we are making probably more progress against our strategic goals than we anticipated. So we're pleased with performance so far. And more latterly, October and November, and it's continued into December, we are now showing record revenues for the business. So we are clearly moving significantly forward in terms of our growth plans. Our growth in the first half was, as far as we're concerned, we're very comfortable with those growth numbers, and we are clearly making sure that all of our performance is in line with expectations and the numbers that are out in the public domain. As far as our market share is concerned, with the gains that we've made over the last, or certainly over the first half, we are now approaching and over 50% of the discount market. We are still very comfortable with that amount, and we will continue to grow in that sector, and we are particularly pleased to be in a space that has an annualized growth of approximately 10% per annum. So clearly that gives us plenty of space for further growth. And the previously advised contract gain came into play in the period, and I'll touch on that in a little bit more detail later in the presentation. As far as Lidl is concerned, it did launch on time and in full, and again I'll touch on that a little bit later. Our investment in the Leyland site, which we also announced earlier in the year, is progressing to plan, and we are expecting to see first product off the lines by the end of this month. And when it's totally operational, we will have capacity for in the region of 160 to 180 million pounds of turnover per annum, and I'll explain a little bit about why there's a variance later in the presentation. In terms of the resource within the business, I think one of the concerns, and certainly one of the areas that people were most concerned about, is a family business transitioning into a PLC. The family have been very, very supportive and very collaborative, and they are now out of the business, though we still have the ability to call upon them for any issues that may arise, and we had a consulting period where they were employed within the business, and they remain clearly major shareholders, and actually they're our landlords as well, so they do have a large vested interest within the business. In that period, we've replaced them with a fully functioning operating board, so we've populated that team, and we've also recruited certain key areas across the business where we had gaps, and it's all about creating a platform for future growth. In terms of our hedging and our parent real sourcing, we're going to go into some detail about that, because I know it's a question that a number of you have certainly sent through to Hannah, and it is clearly important. But the key headline is that certainly in the first half, a combination of our hedging and our aggressive sourcing has meant that we've actually enhanced our margin in the first half by 1.1 points. Because of that, we're still confident of our dividend policy, so we will be clearly making the first payment at 2p, and we are also confident of a full dividend at the end of the year. As part of the governance process, we've clearly the new board with the two non-execs have been, we've had 4 board meetings. We've also had our first ever AGM, which went well up in Blackburn, and all the resolutions were passed. So that's a brief overview. what I'll now go into a little bit more detail about some of those operational areas. And what we've done is actually put it into a number of blocks. Firstly, about growing the top line in terms of sales growth, and then talking later on about growing the bottom line, protecting our operating profit, and then we'll talk a little bit about our thoughts on potential expansion into other marketplaces. As far as, so coming back to the discounters, yes, our share is now 50%. It's 50% on a run rate. So at IPO, we were clearly at 35%. And some of the contract gains, the annualisation of the Aldi gains that we'd made in prior year, some of the new contracts such as clearly Booker, Pound Stretcher and more latterly Lidl have taken our run rate to over 50%. Again, to re-emphasise, we are very comfortable with that. It is the fastest growing segment and all the marketplace data would support that. We are looking at compound growth of 10% per annum over the next 2 to 3 years, which clearly means that our base business is going through an organic growth process as well as the new contract gains looking forward. In terms of the contract wins, the Lidl one was the most significant because it was a expansion into more of a retail based product. If you look at the way that our customers are categorised at the moment, Lidl and Aldi are classed as discounters. We don't actually think that will be too much longer before they're classed as UK multiple retailers because of their size. So for us, this is the first, sort of the second foray into what we would call more classic retailers as opposed to discounters. The early indications from that contract are very encouraging. As far as Lidl are concerned, we had a promotional launch in October and then the main body of the products were launched in November. So our H1 numbers only include a very small element. I think it's about 400,000, isn't it, James?
Yeah, that's right.
So that clearly will start to take a grip on sales as it goes into the second half. In true retail style, they always have a go at us about our ability to forecast. The first orders that came in from Lidl were actually 70% higher than we were expecting. And just to give you a feel, that's about 1,000 pallets worth of product. We did in fact deliver all of that on time, if not necessarily in full to begin with. And our view at the moment is that that contract will in fact be worth more than 10 million and nearer to 15 million pound per annum for us. We've also made significant progress in our target to enter into greater business with the major multiples. We are working closely with them and they are wanting us to be seen to be putting capacity on the ground before they will clearly move product from one place to another. So we're working closely with them on our Leyland facility so that they are fully engaged from really the onset in terms of the layout and some of the potential capacity constraints that we're trying to move through and create additional capability for the future. And in terms of new tissue technology, which I think we've talked to you about before, or you may have seen in some of our press releases, basically it's a much softer tissue. We use that to leverage a launch into Lidl, and whilst they have exclusivity on that in the discount sector, clearly we have a lot of interest from the major multiples in what is a very high quality tissue product that is certainly probably the best in the marketplace, though we would say that, wouldn't we? So moving on to the bottom line, clearly, which is very important. It's one thing growing your top line, but you need to have quality of sale. So there are a number of areas of focus within the business from an operational perspective. The first is, apart from just looking at increasing our capacity, we're looking at how we get more out of the facilities that we've got in Blackburn. So we're looking at a manufacturing optimization program, which is a bottom-up review with the senior ops team now supported by a new manufacturing director, and we're looking at investing in engineering support, in training our staff, and we genuinely believe we can get a further 10 percentage points improvement in our operational program. which is, if in effect, it's the equivalent of one brand new machine. So that's an ongoing program that is deeply embedded into the business. We have talked about Leyland. As far as Leyland is concerned, it's on plan. The 2 new lines have been installed, and as we speak, we're in the process of recruiting labour for the site. We're looking for 80 people initially. They'll go through a training program, and we are expecting to have the first products off the lines at the end of January, and they will work in anger through February and through March. Leyland itself as a site has room for 4 further lines, so a total of 6, but at the moment clearly we're focused on making sure that we get the first 2 lines up and running. A further work stream is really about how we get a better supply chain solution. Our current supply chain solution is suboptimal, and what we've done is basically reproduced a small model a number of times over, which has basically meant we've ended up with 6 warehouses which all have duplicated cost, duplicated management, added complexity if you're trying to assemble orders and pick orders. So we are evaluating what we would refer to as a big shed solution, and we're well along the path of identifying a site and moving to a different model which is much simpler and will allow us space within our footprint within our manufacturing facilities to actually put more conversion lines, clearly, which is much better return for that space. I have previously mentioned investment in people. Clearly part of the investment is twofold. One, to replace the Hussein family, because clearly there were four members of the family in the business carrying out various functions across the business, so we've had to backfill their workload, and there were also significant gaps in key areas that if we're creating a business that's fit for purpose and looking to we have an ambition to double the size of the business, we're making sure that we're bringing in key hires that will enhance our performance. Therefore we've overspec'd a little bit, which has cost us a little bit in terms of investment, which James will touch on later, but we are really looking at putting together a high performing team in the functions that you can see on the slide, and it's really across the piece. Final piece on raw material sourcing, which I know a number of you have asked questions about. Our model is unique. We continue to source parent reels at competitive prices, and in fact we've been very successful in driving prices even further down in H1. It's a nice little saying which Javid Father often sort of told me in our handover period, that Accrol is actually the biggest converting business in the world, tissue converting business, that doesn't have a paper mill. And as far as we're concerned, that makes us unique. It has a number of benefits. That model we will continue to follow, and I'll touch on that a little bit later on as to the why and the benefits that we believe it brings to us. And clearly what we've been able to demonstrate is our ability to source paper at aggressive prices has offset weakening of the pound, and hence we've seen some margin enhancement in H1, which I think has surprised a few people. An area that we are very much in early stages of is recovering the margin from the EU referendum. Clearly the pound has collapsed against the dollar. We therefore are evaluating how we make sure that we protect our bottom line. Clearly we've touched on, and James will touch on, our hedging policy and some of the activities we've enhanced around those policies. But in the main, we've got a set of work streams that are actually all about protecting now really our FY18 numbers. But one of the big areas will be price recovery. We've already started to talk to our customer base pre-Christmas around some of the potential price increases, so we've been warming them up. We are talking to basically our away from home business first, because that sector is has an amount of product that comes in from abroad. So we have plans and letters already in place to recover prices in that sector from the 1st of February. The bigger contracts clearly take more focused discussions. We've also taken the step of bringing in some outside resource to help us on getting those price increases away, because clearly the marketplace has been used to price deflation, not price inflation. In fact, some of my sales team have never had to get a price increase before, so we're using the opportunity to enhance the opportunity by bringing some training and also some assessment of my commercial team. Finally, around cost reduction, so apart from the work streams that we've talked about around the operational efficiency of the business, we're also, as you would expect, looking at how we buy better, not just in paper. So we brought in a procurement professional to help us look at packaging, things like that, tender processes. And as you would expect us to do, we're constantly looking at our headcount review, focusing more on quality rather than on numbers of people. One of the areas that we are also starting to look at, and this has been a project undertaken by Peter, our chairman, so that we're not distracted from clearly the heavy workload that James and I have within the business, is our thoughts around potentially expanding not just within the UK, but potentially in Europe. And that's based on the principle that Europe is a very similar model to the UK, where mills and conversion businesses tend to be vertically integrated, and we genuinely believe that there is an opportunity for an Accrol type model in Europe, because the paper products are very similar, almost identical, and also leveraging some of our relationships with Lidl and Aldi into their much bigger estates in Europe. But it's very early days, and clearly we'll update anybody and everybody as and when that may become more concrete, but it's very preliminary. Passing over to James, who's now going to touch on the financials.
Thanks, Steve. Good evening, everybody. One of the areas that I've spent a lot of time on over the last few months is hedging and currency. What we've done over the last few months is doubled our hedging facility, which gives us the capacity to be able to take hedges out at a deeper level over a longer period. Pre-Brexit and post-Brexit, we took out significant currency hedges, which has allowed us to deliver the improvement in gross margin that we've seen in the first half. So, as we're all well aware, sterling is depreciated by 15% versus the dollar since the referendum. We've been able to hold that at 6% through the hedging. What we've been also able to do, following on from what Steve said, is reduce the paper pricing by 7%. So the 6% and the 7% are giving us a net benefit of 1.1% into gross margin. As I've said before, we have taken hedges out over a longer period. We are fully hedged in FY17, and we continue to follow the same policy as we move into FY18. In terms of just running down the P&L, the revenues have gone up 8.8% or 5.2 million. Majority of that was driven by the new contracts that Steve's alluded to. Gross margin, I've touched on and talked us through that. One thing just to bear in mind is that because we've now been able to apply hedge accounting, it means that any movements on the currency contracts no longer go through the P&L, so it makes the P&L cleaner and more comparable. Overheads have increased. Taking out the exceptional items have increased 2.1 million. 0.9 of that is due to distribution. Obviously we've got higher sales, and the balance of that is largely due to PLC costs and investments in people that Steve's already talked us through. Finance costs have reduced significantly on the two halves, largely as a result of refinancing the business and removing the more expensive debt. An adjusted profit before tax, which excludes exceptional items, amortisation and the movement on the derivative financial instruments, has gone up 1.9 million or 67%. In terms of the cash flow, our cash generated from operations as a percentage of the adjusted operating profit is 85%, meaning that we are turning our profit into cash quicker. Working capital only increased by 1 million. So despite the increase in sales, we've been able to keep a tight control of stock and debtors. The interest paid is showing a 3.8 million outflow in this half, the majority of which, 3.6 million, is the loan notes. So as we move forward and we get clear of this year in the old debt structure, we'll see that reduced to around about £1 million following the refinancing. And just following on from that, the net debt at the bottom has reduced 46 million as we've taken out the loan notes, we've repaid the finance leases, which has allowed us to reduce the interest charge to the business. And we're running at just about 1.2, 1.3 times EBITDA at 19.9 million of net debt. In terms of the balance sheet, I've talked through the working capital, I've talked through the net debt. The other number that's interesting on the balance sheet is the derivative financial instruments. We've got an asset of 4.9 million. So when you look at the currency contracts that we've got outstanding at the balance sheet date and revaluing those to the spot rate, it gives a gain of 4.9 million. With the difference on the revaluation now taking through the reserves, which you can see the hedging reserve has come in this year at 5.1 million.
What we want to do here, and apologies for repeating a little bit of this because it is quite important, and I know it's been the source of a number of questions from our audience. What we're really trying to emphasise is that this business is well used to fluctuations in exchange rates, and over history has been able to leverage its position and its supply base to more than compensate for any fluctuations in the exchange rate. And as we've demonstrated in the first half, by a combination of parent real pricing and hedging, we've been able to compensate for a fairly significant change in the exchange rate, and hence we've got a margin gain. If we then look forward into, probably more importantly, into the rest of FY17, we are still very confident on the marketplace being benign in terms of parent real sourcing. There is overcapacity still across the world. We do see new capability being put in place on both pulp mills and paper mills, and that's not only new mills that are being built and therefore come to talk to us, but also you're seeing a conversion of paper mills that have produced typical A4 type paper, traditional paper, looking to convert their capacity towards tissue because they can see a very big and very sustainable marketplace, because clearly as we look forward there will always be a need for tissue based products. We use the model, clearly gives us significant benefit. We tend to trade with 7 or 8 paper mills and we get very close to them. We tend to pick on family based businesses and set up a relationship, a collaborative relationship, and we take big positions in their business so that they become dependent upon us. However, we have access to up to 30 mills across the world, and when we say across the world, we do genuinely say that. We have paper that comes from Chile, we have paper from North Africa, we have paper from Turkey, we have a little bit from the UK, we take paper from places like Indonesia. So generally, we see that trend continuing, allowing us to leverage one supplier against another to make sure that we look forward and ensure that we are very, very competitive. So in terms of our outlook, I think we've publicly said that we are confident in our FY17 numbers. A combination of the activities that we put in place on hedging and our forward purchasing on paper basically puts us in, we would believe, a very confident position about our full year situation. We also, a lot of people would be quite sceptical about the EU referendum and the impact on businesses. We see it as a significant opportunity for a number of reasons. One is, as you're probably aware, and it's very, very public, that price increases are inevitable in the marketplace. Many commodities within the UK retail sector are basically dollar based. For information, pulp and paper, tissue is all dollar based in terms of marketplace. So the difference between ourselves and our competitor set, if you've got a mill, you are still buying your pulp to go into that mill in dollars. So we are all facing into the same issue as a marketplace. So it's an opportunity for us, and these things only come along every 4 or 5 years, to move prices up to make sure that we're not out of pocket. The other opportunity that we see from this particular set of circumstances is that the inflationary volumes that will be coming through, UK shoppers are very, very savvy. They will be looking at prices, and we see the shopper behaviour moving even further towards looking for value and quality, hence into the discounter marketplace. So we see that as a significant opportunity going forward, and hence we are looking at further capacity for our Leyland site, and looking at the opportunity to purchase further equipment to make sure that we're in the right place to accept that volume. So the second half, it's really what we talked about. It's about getting selling prices away. It's about improving our efficiency in both our manufacturing and in our supply chain. It's about getting Leyland up and running as soon as possible, and that's on plan. It's about maximising the benefit of our new people across the organisation. And all of these things are combined to make sure that we've got work streams in place to not only protect the FY17, but to also protect FY18 forecasts. So we are optimistic about FY18. That may be a surprise to some of you, but we believe we've got enough work streams within the business, including the inflation recovery, to make sure that we continue the progress made by Accrol. In terms of our dividend, we are still intent on a progressive dividend policy. We're still intent on the 6p, clearly 2 for now, 6% on IPO launch of £1, and we are, as we mentioned, looking initially at potential acquisitions, and we've got external help on that to evaluate potential opportunities. So that's a summary of our results. In summary, we are actually very pleasantly pleased. We're pleasantly pleased, that's wrong. We're very happy with them, and we are clearly now very much focused on delivering FY18 to keep our investors happy. So, any questions?
Thank you very much. We've had a couple of questions through, so let us make a start, trying to tie a couple in together. As you said, there's been a fair amount of discussion around, let's choose pricing to begin with.
Yep.
How successful do you think you will be in pushing through price increases? I mean, we've heard lots about it in the news. We've seen Unilever and Tesco going head to head. Given your size and given the size of the customers that you are supplying, how much pressure do you think you can bring to bear?
I don't think it's pressure. I think there's an inevitability about this. Normally, if you've got price movements and they're small price movements, they are something like 1 or 2%. The normal pushback you'd get from a retailer would be, you can absorb that into your operational performance, go and find cost saving processes. This is so significant that there is basically, and the feedback that we're getting from the buying world is that it's more a case of when and by how much, not if. And we've clearly seen major public sort of climb downs. A very interesting one from Marks and Spencer of late, where they went out initially saying that they would not put prices up on the back of exchange rates, and they've had to do a major U-turn over this last weekend, for those that saw it in the press. We're confident that we will get price increases away. I think one of the questions that we were asked before the presentation by one of the people online would be, are you in the same position as your competitor set? We're all facing into it. And I've tried to explain that even if you've got a paper mill, no matter where it is, pulp comes from abroad and it's priced in dollars. That's what they use to produce their product. We just happen to buy parent reels at a stage farther along. So we've all got inflationary headwinds to face into, and we are confident that we will get those prices away. It's just when, and sort of the usual negotiations, which I've been involved in for many years with retailers. They recognise that it will happen.
Perhaps then, as an extension of that, we can talk about the visibility of parent roll pricing. Do you want to, obviously you're saying that the prices are very low at the moment, and you've managed to take advantage of that with your policy to source from over 30 mils. You want to make a comment on where you see those prices going forward?
No, we don't tend to talk in prices because that's commercial information and it's not for the public domain. What we would say is we've clearly, as you've seen, we've been able to further reduce our prices in H1. We've bought forward and we've extended our, in a way, not dissimilar to hedging dollars, we've been hedging on our pricing. So we have a target that we set ourselves internally. Because we've got knowledge of how paper mills work, we tend to work on making sure that we don't buy anything at a price higher than a paper mill could produce that product in the UK. And the reason that we can leverage that is that a lot of our paper clearly comes from mills that have cheaper utilities, cheaper labour, etc. in Europe. And also we've got that leverage that allows us to play one off against the other and be very flexible. Certainly we've been very successful at that in the past, and we believe we will be successful at that in the future, and we certainly see a period of 4 to 5 years where there will be excess capacity.
Okay, thank you. You touched on trying to narrow down your 6 warehouses into a big shed solution.
Mm-hmm.
Have you got a time frame for that, or capex that you want to expand on?
In honesty, we're still working very much on the project. We see a small potential increase in capital, but it's actually a leased building that we're looking at, so it won't be a big cost to the business. If anything, we see it as being a cost-saving process going forward, and it's a much simpler model. We have identified a site. We are negotiating heads of terms literally as we speak, and it will happen probably sooner than people expect, because we want to make sure that we can put capacity into Leyland for manufacturing as opposed to using it for a warehouse.
Thanks. Okay, on to couple of questions, try and tie them in together on competitors. Firstly, who did you win the Lidl and Booker contracts from? And secondly, what do you see as the sort of the barriers to entry in this market, and perhaps adding to further pricing pressures?
The latest Booker contract was from one of the smaller manufacturers in the UK. The Lidl contract in the main was from one of the bigger manufacturers, and generally the retailers are quite confidential about product moves and where it goes from and where it goes to, so I don't think it's our place to say where it's actually come from.
Okay. Well, we shall accept that. Now, another question here, touching on an article that was apparently in the Telegraph a few days ago, that the market is falling significantly in tissue products. First of all, did you read that article? Not what I've seen.
I have to say that I didn't actually see that. I don't read the Daily Telegraph, and normally our PR agency would pick up any relevant information. I'm not quite sure what they mean by market. They may be referring to marketplace prices. The marketplace, i.e. the selling of tissue-based products, is in growth, and it tends to reflect the population growth for obvious reasons. So it's a steady growth. Within the marketplace there are significant dynamics that are changing. So you're seeing the big branded players, one in particular who we all know, that's got lots of little cuddly puppies running around, is hemorrhaging volume at the moment, and that sale is transferring into private label in the major multiples and into the discounters, because to be honest the value that they represent and the quality is, well, first of all it's been downgraded, and if you look at the available competitor products in an Aldi or a Lidl, as I would clearly suggest you go and have a look at, you'll find that they're as good as, if not better than, the best in the marketplace, but at significantly discounted prices. And when we mean significant, we mean significant.
Well, I think that brings us neatly back round to the NTT product. Obviously, that at the moment is exclusive into Lidl as a discounter. As you look to sort of, I'm sure, sell that into the multiples, will you give exclusivity there, or will you be able to take advantage of the market opportunity?
Well, if we go back to NTT as a product, we have UK exclusivity on. So it's only produced in 3 mills across the world. One in Mexico, which is entirely taken up with volume going into the States. One in Chile, which we take from, and another one in Abu Dhabi. And we have exclusive arrangements with both of those mills for us to supply that product into the UK. We used NTT to gain the Lidl contract, so it's the door opener, the exclusive period within the discount sector. We would not necessarily want to give exclusivity within the major multiples, and that's all part of a negotiation as we go forward.
Okay, thank you. At the moment, directors' holdings are relatively modest, as one questioner asks. Do you have any plans to expand them?
Well, I'd love to know what people describe as relatively modest. I'm sure my chairman wouldn't say that his substantial shareholding is relatively modest. If it's a question to myself, because I've got the smallest shareholding, I actually did buy some, as you promised, before Christmas. I haven't been allowed to buy any since, and it is within my plans going forward. I'm confident enough in my business to be able to say that I will be buying more shares as we go forward. I've not been able to during the closed period.